Before we begin, just a quick note. This podcast is produced by qualified financial professionals and is intended to share general information and insights to help expats better understand common financial topics. However, everyone's circumstances are different and regulations can vary by country, so nothing discussed should be taken as personal financial, tax, or investment advice. If you're considering making financial decisions based on anything covered in this episode, we recommend seeking professional advice tailored to your individual situation.
Hi, I'm Georgina, and you're listening to Expert Money Matters. At Chase Buchanan, we know your time is valuable, so we've taken our signature weekly market update email and turned it into this easy-to-digest audio briefing, so you can stay informed while you're on the move. Here is your weekly market update for the 21st of June, 2026.
Good morning or good afternoon, depending on where you are in the world. This week's landscape is being shaped by major developments on several fronts we highlighted in our previous update. In Westminster, the political situation has moved quickly. In global energy markets, there are encouraging signs of stabilization. And for cross-border families, the bigger picture remains clear. European tax rules, global mobility and pension planning are becoming more complex, not less. So let's start in the UK. Westminster, an orderly transition. In our previous update, we looked at the Makerfield by-election and the possibility that it could raise fresh leadership questions for the Labour government. Those questions were answered on Monday, the 22nd of June, but in a relatively measured way that markets appear to be digesting calmly. On Thursday, the 18th of June, Andy Burnham secured a decisive victory in the Makerfield by-election, returning to Parliament and strengthening his position as a serious leadership contender. Then, on Monday, the 22nd of June, Sir Keir Starmer announced his resignation as Prime Minister, setting out an orderly transition process before Parliament returns in September. Andy Burnham has confirmed his candidacy and the party timetable is now being set. At this stage, the key point is not the political theatre, but the fiscal reality behind it. For expatriates, it is important to separate political noise from policy reality. Starmer's departure triggers a leadership transition. It does not create an overnight change in the UK's fiscal arithmetic. Public borrowing remains high, and that leaves limited room for sweeping tax cuts. The next leader is still likely to look closely at personal taxation, capital gains tax, and inheritance tax as potential revenue levers. That does not mean people should rush into panicked restructuring. Quite the opposite. An orderly transition gives families and advisors time to assess the new leadership's policy direction properly and then plan defensively and deliberately. Turning to global markets, there has also been some relief on the energy front. The high-level talks at the Bergenstock Resort in Switzerland have concluded positively, avoiding the breakdown that many investors had feared. Markets reacted quickly to the easing of tensions. Brent crude moved lower, trading around the $79 a barrel level, which has helped cool the inflation concerns that had been building earlier in the month. That matters. Lower energy costs are a relief for central banks, for households, and for expatriates living on fixed or internationally exposed income streams. In equity markets, the aftershock of the historic SpaceX IPO is still being felt. After an initial surge following the listing, the share price has pulled back sharply from its post-IPO highs. At the start of the week, it was still trading above the original offer price of $135 per share, but below its first-day closing price. That may move again by the time you hear this, so the important point is not the exact share price on any given day. The bigger issue is volatility and concentration risk. When a very large new listing enters global indices, passive investors can find themselves with greater exposure to a small number of mega-cap names, even if they have not actively chosen to increase that exposure. For anyone whose retirement assets are linked to a passive global tracker, this is worth watching. As indices adjust to accommodate such a large listing, exposure to a relatively small number of mega-cap names can increase without investors actively choosing to take on that extra concentration. That does not automatically mean action is required, but it does mean investors should understand what they actually own. Now let's turn to the cross-border planning picture. The era of broad, easy tax arbitrage is over. In 2026, the opportunities that still exist are more targeted, more technical, and more dependent on getting the structure right from the start. This is especially true for individuals with UK pensions, US connections, or legacy tax statuses in Europe. For British expatriates living in the United States, 3 changes over the past 18 months have quietly reshaped the planning landscape. First, a 25% overseas transfer charge now applies to many overseas pension transfers. Second, from April 2027, most unused UK pension funds will fall within the estate for inheritance tax purposes. And third, several major UK platforms are closing accounts for US resident clients. Those closure letters should not be ignored. The deadlines are strict, and missing one can force an unplanned liquidation of assets. These UK changes are already significant, but for US-connected individuals, the situation is even more complex because the IRS layer has to be considered as well. Mismanaging a UK pension or transferring it in the wrong way can create foreign trust reporting issues, including Forms 3520 and 3520A. It can also raise passive foreign investment company concerns as well as FATCA and FBAR reporting obligations. In plain English, this is not an area for generic offshore planning. UK pension transfers for US residents require extreme precision, and the US-UK double tax treaty is often central to the analysis. Portugal, the NHR countdown. Portugal is another important area. The non-habitual resident regime, often referred to as NHR, is now closed to new applicants. However, thousands of expatriates are still living within their 10-year NHR window. For them, the key issue is what happens in year 11. Once NHR status expires, residents generally move into Portugal's standard progressive tax system. Those rates can reach up to 48%, and there may also be exposure to wealth-related property taxes for higher value properties. The danger is waiting too long. Leaving NHR exit planning until year 9 is often too late. Proper planning may involve restructuring portfolios, reviewing how trusts are treated, and optimizing dividend flows well before the deadline arrives. Malta. A dual pitch to retirees and professionals. While Portugal has been tightening, Malta has been moving in the opposite direction. The Maltese government has significantly increased its tax-exempt pension cap to €37,104, alongside tax measures that may be attractive to certain retirees. Beyond standard residency, Malta also offers structured pathways depending on a person's life stage and circumstances. The Malta Retirement Programme is designed for retirees who receive income primarily from pensions. It can offer a flat 15% tax rate on foreign income remitted to Malta. The Malta Global Residence Programme is aimed at non-EU, non-EEA, and non-Swiss nationals. It also provides a 15% flat tax rate on remitted income, provided the relevant property purchase or rental thresholds are met. As always, the detail matters. These regimes can be attractive, but only when the individual's income, assets, residency position, and long-term intentions fit the structure properly. The bottom line is this. This week's events underline the value of a measured approach. We have an impending change of UK Prime Minister. We have shifting energy prices. We have global indices adjusting to one of the largest market listings in history. And we have tax regimes across Europe becoming more targeted and more technical. For cross-border families, successful wealth management is not about reacting to every headline. It is about understanding the direction of travel, identifying the planning windows that still exist, and making deliberate decisions before deadlines force your hand.
And that wraps up this week's Market Snapshot. If you'd prefer to get the information before it's published here, you can sign up for the update directly on our website. Just visit chasebuchanan.com and subscribe and get the update delivered straight to your inbox, giving you a head start on the week. Thanks for listening to Expert Money Matters. I'm Georgina. Join us next time as we explore money matters for your life abroad.